Non-constant growth stock valuation with Diana Temsky, the University of Wisconsin, La Crosse. So when growth isn't constant, what do you do then? You just assume that Gordon model, and with the Gordon model, we assume growth would be constant essentially forever. And for some stocks, for stable, mature companies, that works. We can find an average growth rate over time that can be applied. It works perfectly, but that's not all stocks. So what do we do then? And there are times, and your textbook mentions this, I'm sure you read it as you read through chapter 9 in your text, that there might be supernormal growth. This period of time in a stock's life, if you will, where, and sometimes this is the case for stocks when they first go public, where growth is just astronomical, maybe 20-30%, where the company is just growing and the stock's growing leaps and bounds for a couple of years, and then it tapers off. And that is a trend that often does happen, where there's supernormal growth that occurs for a few years, sometimes a year or two, maybe 3. It's quite typical for that amount of time. And then it's followed by a more stable level of growth over time. The Gordon model won't work entirely, so now what? Now what do you do? Well, we can use the Gordon model in part to solve problems like this, but we have to do a couple of other things. So what do you do? I like to lay it out in 5 steps for students. Your textbook author goes over it a little bit differently. That's totally fine. I've taught this class a number of times. I've been teaching it for, 5 years, which doesn't sound like a lot, but 2 semesters a year. I've found that this seems to work best for students to kind of take it step by step by step in approaching the problems. If you don't like this, well then have at it, read what your textbook author has to say and follow your textbook author's pattern. And that's totally fine if you don't like how I approach something. So here are the 5 steps I show students in how to solve these types of problems. So the first step, find the value of dividends in the first growth period. In that first period of time, whether it's 2 years, 3 years, however many years, find those dividends. Step 2, find the present value of those dividends using R sub S as your I, and you can use your BA2 Plus calculator for that. Step 3 is to find the forecasted stock price at the beginning of the constant growth period. That's essentially the horizon date, and you can use the Gordon model for that. The expected stock price at the point when the growth becomes constant is also called the horizon value. Step 4 is to find the present value of the stock price you just found. And then step 5 is to put that together, those 2 present values, add them, and that's your intrinsic value. So how do we do this? Let's look at the problems 6, 7, and 8 on your problem set, and you can see how this works. So problem number 6, it says, due to unfavorable conditions, Cramerica's earnings and dividends are expected to remain unchanged for the next 3 years. After 3 years, dividends are expected to grow at a 10% annual rate forever. The last dividend paid was $2, so that's D sub 0. The required rate of return is 20%, that's your R sub S. And your question is, what should be the current market value of Cramerica stock, or what should be the intrinsic value? What is the intrinsic value? So the first step, given the steps I outlined to you, is to find the dividends during the first period. And the first period is the first 3 years when economic conditions remain unchanged. So this is not exactly what I just described to you a few minutes ago, where there's this super or normal growth. There's actually a period of no growth, and that can occur as well. So they remained unchanged. $2 was the last dividend, so that's what the dividends are going to be for the next year, the year after that, and the year after that. So for the first 3 years, they're $2. You can use your calculator for step 2. Just use the annuity function. $2, 3 years, 20% required rate of return. Solve for the present value, and you should find it's 4.213. When solving these problems, I recommend students keep it out to as many decimal places as possible so you get the most accurate answer, so you're not rounding all the time and leading yourself to something that's not even close to correct. Step 3, find the stock price when growth becomes constant. So when growth becomes constant, that's going to be after 3 years. So that's basically P sub 3. Conditions remain unchanged for the next 3 years. After those 3 years, that's kind of your cue for what your sub number is going to be, if you will, for the price. And in this case, it's going to be 3 when growth becomes constant. So P sub 3 is going to equal D sub 3 times 1 plus the growth rate divided by the required rate of return minus the growth rate. Notice that it's just like the Gordon model you've been working with so far. These two things have to essentially have the same subscript number. If not, if you wanted to do P sub 3, you could look at P sub 3 equaling D sub 4 divided by R sub S minus G, and that's totally fine. It's the same thing, but oftentimes using the model I've just set up for you, you haven't found D sub 4 yet, and that's what this is here. So $2 was the last dividend paid. It stayed the same, so that's what D sub 3 is, times 1 plus that 10% growth rate that this stock is going to experience when it starts growing at a constant rate, divided by 0.20 minus the 0.10, and you should find that that's $22. Step 4 is to find the present value of this stock price. This is a future stock price when growth becomes constant, so that becomes a future value. You have 3 years, 20% required rate of return, solve for your present value, and you should get 12.7315. You add those present values together, and you should find that it's $16.94. Rounding at the end is perfectly fine, and I encourage you to do it. Round at the very end because that's how I express dollars and cents. Big reminder, when we solve for the values of securities, it's the present values we're solving for. Okay, the value of any security is the present value of its expected future cash flows. So that's why we're solving for present values. There's my notes. That's just my solution set scanned for you. And the second part of the question says, you see that Kramerica stock is trading for $20. Would you purchase it? Nope. You just found that the true value is $16.94, so it's actually overpriced in the market. It's not worth it. So moving on to number 7. You're considering the purchase of a common stock that just paid a $2 dividend. You expect this stock to have a growth rate, a supernormal growth rate of 30% for the next 3 years. Then after that, to have a long-term growth rate of 10%. You require a 15% rate of return. How much would you be willing to pay for this stock? So sometimes I find it's useful to sketch out the timeline of the dividends for students. If that helps, great. If not, great. So the first step in the problem, once again, it's including 3 years in the first growth phase, or non-growth phase is in the first problem we looked at. Find the value of those dividends, D1, D2, D3. You use the previous dividend to find the next dividend. You can look in your textbook or at your equation sheet for a reminder of exactly what we're doing here. So $2 was our last dividend, times 1 plus the 30% growth rate gives us $2.60 for our D sub 1. Now to find D sub 2, you can do this. You can do $2 times 1 plus 0.3 to the second power. That works. Or you could just do $2.60 times 1 plus 0.3. That works as well. These are your dividends you should find when you solve for them. 260, 338, and 439. The second step is to find the present value of those dividends. You can use the net present value function in your calculator to do that. These are your 3 cash flows. This is cash flow 1, cash flow 2, cash flow 3. No cash flow at point 0, okay? We're only concerned with expected future cash flows, not the last cash flow when we're valuing the stock. Your I is the 15% required rate of return, and when you plug this into your calculator, you should get $7.74. and 0.7031 cents. Okay. Step 3, find that price when growth becomes constant. Once again, it's P3. So you take the D sub 3, which you found up here, $4.39 times 1 plus the growth rate when it becomes constant, which is 10%, divided by 0.15 minus 0.10 to get 96.58. That becomes your future value over 3 years at 15%. Solve the Add your two present values together, the 7.7031 and the 63.5029, and you should get the intrinsic value of $71.20. The question you have below that is, you see that this stock is currently selling for $65 per share. Would you buy it? Sure. It's selling for less than the intrinsic value. You just found the intrinsic value is more than $65. It's $71.20, so it's basically a bargain. All right, one more problem. The Banya Corporation is expanding rapidly and currently needs to retain all of its earnings. Hence, it does not pay any dividends. However, investors expect Banya to begin paying dividends with the first dividend of 75 cents coming 2 years from today. The dividend should grow rapidly at a rate of 40% per year during years 3 and 4. After year 4, the company should grow at a constant rate of 10% per year. If the required rate of return is 16%, what is the value of the stock today? So a lot going on, a little different than what we've just done, okay? No dividend has been paid. No dividend is going to be paid in the coming year. The first dividend is going to be paid 2 years from today. So that's D sub 2, and that's going to be 75 cents. So step 1, finding these dividends. 0 in year 1, year 2, 75 cents, year 3 and year 4, you can find those dividends using the 40% growth rate. Then you can do step 2, find net present value of those 4 dividends using I equals 16% to solve for net present value. These are your cash flows. Nothing in year 0, 0 in year 1, 75 cents year 2, $1.05 in year 3, and $1.47 in year 4. And you should find the net present value of those dividends to be $2.0419 for the cents. And then step 3, the last 2 problems we looked at had us solving for P3. This one's different. I did it intentionally to have you do something a little different than what you just did. So this is P sub 4. So P sub 4, this is the price when growth becomes constant, is going to equal D sub 4 times 1 plus that growth rate we expect to become constant. And that's $1.47. That's what D sub 4 was up here, times 1 plus the 10% growth rate. That's what's going to be when it's constant, divided by the required rate of return less that growth rate to give you $26.95. So that's the future value for today. That's what you expect that stock price to be when growth becomes constant. So you plug it in as future value. N is 4, I is 16, and you should find a present value of 14.8842. Add them together, and you should find that the intrinsic value is $16.93. That's the true value of this stock. I encourage you to work on non-constant growth problems on your own. They are tricky and they do take practice over time. Any questions, let me know. Otherwise, happy studies.